Well, good morning or good afternoon, everyone, depending on where you're joining us from. Thanks for joining. We had just a last-minute technical thing. We got started a couple minutes late, but appreciate everybody's patience, and I appreciate everybody making the time to join live here. Real quick, I'm Tim Krause. I'm the head of sales here at Financial Brokerage. If this is your first time joining us for a webinar or you're not familiar, I've been in financial services for about 15 years. Financial brokerage has been around much longer than I have. A good mid-size IMO, we're big enough to offer extras incentives to you guys, like our Success Share program, but still small enough that we can give everybody an individual level of service. So if you're not familiar with myself or us as an agency, feel free to reach out to me, and I'd happy to have a longer conversation about what we might be able to offer to you. Couple housekeeping notes real quick. You guys are all on mute, which is just good for us to make sure we have good, clean audio. This presentation will also be recorded, and we will send that recording out to everybody after the call as well. Just because you're on mute doesn't mean we don't want to hear from you with questions or comments. So use that question function on the right-hand screen. I'll monitor that throughout the presentation. And if you have a question or comment, you can use that. We'll bring it up as those go along, and we'll make sure everybody gets their questions answered. If we happen to run out of time, I will be able to still see all of those questions in there, and we'll follow up with everybody as appropriate. Last thing I'll mention before I turn it over to Bob Klein with American National here is that if you are looking for something to take advantage of the new employer plan tax credit, the Secure Act 2.0, you're in the right spot. I would also say if you're not in the state of Connecticut or Massachusetts and you're not securities licensed and we're looking for an offering to be able to help employers or your business owner clients put plans in place for their businesses, you're in the right spot. Or if you're in any state and you're tired of your broker dealer or your broker dealer has upset you and they're messing up your commissions, you might be in the right spot as well. So with all that being said, I'm going to turn it over to Bob and let him take it away.
All right, well, thank you very much. Good morning, everyone. My name is Bob Klein. I'm the Assistant Vice President in charge of pension sales at American National Insurance Company. I myself have been in the retirement plan business for 40 years now, and I'm here to talk with you this morning about what I call my top 10 plus 1 provisions in Secure Act 2.0. And one of the things that we'll be talking about quite a bit are the new plan tax credits that came along with Secure 2.0, but there's a lot more there than just new plan tax credits. And so I'm going to touch on a few other items besides the tax credits, just to give you an idea about what all was in Secure 2.0 and how it might affect your ability to sell retirement plans, as well as service clients that you may have who have retirement plans right now. And Secure 2.0 is called Secure 2.0 because there was a prior Secure Act that was passed and signed into law back in 2019. But there were some items that were in the that were left out of the original Secure Act that the House and the Senate wanted to pass, but for a variety of reasons it didn't happen. And so when the Consolidated Appropriations Act was passed last year, they tacked onto it 92 pension-related provisions, over 360 pages of pension-related provisions that are collectively referred to as Secure Act 2.0. It is not my intention to go through all 92 pension-related provisions. You would be bored to tears, as would I. But I think one important thing to know going into the conversation is that there's still a lot that we aren't sure about. This bill was signed on December the 29th, and people are still digesting it. And there are a number of items that we know are going to need some clarification or technical correction from the Congress. But there are some things that we are fairly sure about that I want to tell you about today. And probably the one that has me most excited because of its impact on retirement plan sales is the new and expanded tax credits that are available for employers that set up new plans. There's been a tax credit available for new plan creation for quite a long time. But what Secure 2.0 did was basically took the old credit that was available and doubled it, as well as adding a new credit. And so I'm going to go into this a little bit more detail here so that you understand what this can mean for the typical employer out there who has no plan today and sets up a new plan, what the government will do to help them along the way in paying for establishing that new plan. What the expanded credit does is it raises the new plan setup credit from what was 50% of the plan's qualified startup costs to 100% of the plan's qualified startup costs. So essentially, the government is paying you to set up a plan. They're going to cover the fees for you. There are dollar limits as far as the amount that you can take as a credit. And it's the greater of A or B, with A being $500, which most new plans cost a lot more than $500 to set up, or B, $250 times the number of non-highly compensated employees eligible to participate in the plan, but no more than $5,000. And you get that credit for the plan's first year plus the succeeding 2 years. And there is also a credit of an additional $500 for plans that include an automatic enrollment provision in their plan. And we'll talk about automatic enrollment a little bit later. So this is very generous credit that the government is making available. And I'll just give you an example of a typical 401k plan using our fee schedule. That they set up a new 401k plan covering the business owner and his 6 employees. The fee to set up the plan is $700. The annual administration fee for a plan like that would be $1,375. This particular plan does not include an automatic enrollment feature, so participation among the employees is voluntary. But in year 1, the first year credit is calculated by adding up the total fees to set up the plan, which would be the setup fee plus the annual administration fee, times 100% is $2,075, but we know there's a cap there of $250 times the number of non-highly paid employees in the plan, so that's 6 times $250 is $1,500. So first year tax credit that the employer could take for setting up the plan would be $1,500. In year 2, since there's no setup fee, the only expense they have related to maintaining the plan is the annual administration fee of $1,375. 100% of that, of course, is $1,375. Our cap is the $250 times 6 people is $1,500. So our second year tax credit is $1,375. And they would also be able to take a similar credit in year 3. So very generous subsidies from the government for setting up and operating a plan. They basically doubled what used to be available by way of a tax credit. There is now a new tax credit available for the first 5 years of plan operation for employer contributions made to a plan for the plan participants. And the credit is equal to the amount contributed to the plan for each employee, with a cap of $1,000 per employee. Employee salary deferral contributions to a 401k plan do not count as contributions for this purpose, nor do contributions to defined benefit pension plans. So we're basically talking about contributions that an employer might make to a 401k plan in the form of, say, a profit sharing or a match, or employer contributions to a straight up profit sharing plan. And in addition to that, contributions for employees who earn more than $100,000 do not qualify for the tax credit. And that $100,000 limit is to be indexed annually for inflation going forward. So the credit phases out over the first 5 years of plan operation. In years 1 and 2, you get to take the full credit. In years 3, 4, and 5, you can see that it grades down in 25% increments. So by the time you get to year 6, you're not going to have a credit for contributions, but you can still take the tax deduction for those contributions that the employer makes going forward. So it's not like all is lost there, but generally speaking, in the tax world, credits are deemed more valuable to a taxpayer than the deductions. And so it's preferable to take the credit as opposed to deductions for these contributions. And so let me give you a simple example of how this tax credit for contributions would work. We have an employer that sets up a straight profit sharing plan for its employees. So this is not a 401k with employee money going in. It is all funded by the employer. The participants are the business owner and her 4 employees. And we going to assume for illustration purposes that the employer just makes the same contribution to the plan and nobody's pay changes over the course of the next several years, just to make it easy for me to demonstrate how this credit works. So we have here our owner and the employees all at various levels of pay as well as various levels of contribution that they are receiving from the employer. In years 1 and 2, the employer's tax credit would be $3,960. So $1,000 each for employees 1, 2, and 3. And that's because if we go back and take a quick look at the example, those folks were all over $1,000 in terms of what they were getting by way of the contribution, and we've got that $1,000 cap. And then for employee 4, $960, because that person's below the $1,000 threshold. Contributions for the owner don't count because she has earnings in excess of $100,000. Her pay is $150,000. That does not mean all is lost. She can still take the deduction for the contribution that she makes for herself, since that is not eligible for the tax credit. So that's years 1 and 2. In year 3, the credit would be $2,970, which is that $3,960 that we just calculated, reduced down to 75%. Year 4 would be $1,980, which is the 50% level, and then year 5 would be $990, which is a quarter of the $3,960. So total credits available to this employer for setting up this plan and for the first 5 years would tally $13,860, which would certainly be a powerful incentive to a small employer who's thinking about setting up a plan and can have the government help subsidize to a very significant level the amount that they put into the plan for the employees. And these tax credits are effective for plans established on or after December 29th, 2022. So these are available right now. And I think that this is, as word gets out to the employers out there who may have been sitting on the fence about setting up a retirement plan, that these credits are available to them. It may actually be costing them money by not having a plan in terms of missed deductions and now missed tax credits. And so I think a lot of employers are going to come off that fence and start looking at setting up new plans going forward. Other provisions in Secure 2.0 that I think are really important for people to know about. And so I'm going to cover them for you quickly here. Number 2 on my list is required automatic enrollment. This is a little complicated, the way that the government did this, but it's the government and nothing's ever easy. The rule is effective now for 401k plans that were established after December 29th, 2022. And what the rule says is that any plan established after that date is going to have to include in it eventually a provision that says that rather than have your people sign up voluntarily to participate in the plan, which is the way a lot of 401k plans work today, is that you're going to automatically enroll your employees in the plan when they become eligible at a salary deferral rate of a minimum of 3% of pay, but you could start them as high as 10%. And then what you're going to do is escalate their salary deferral percentage by 1% per year until you hit a max of 15%. Now you may stop auto escalation at some lower number. You don't have to go all the way to the full 15. A lot of people will probably not even notice that they're having deferrals taken out on an automatic enrollment basis. But if they do, and if they don't want that to happen, they can come back and ask for their money back, provided they do it within 90 days of their initial contribution hitting the plan. They can also come back and say, oh, I don't want to defer at the default rate. I want to defer at a different rate. And of course, they always have the right to stop deferring anytime they want to. The plan can start doing this today if they want to, but at some point or another, a new plan is going to have to implement the automatic enrollment by the first plan year beginning after December 31st, 2024. So in other words, for plan years beginning in 2025, all new plans are going to have to start doing this. There are some exemptions. Businesses with 10 or fewer employees don't have to do automatic enrollment unless they want to. Or if a business is new, they've only been around for, say, 2 years, but less than 3, they are also exempt. So I think that the policy behind this is that Congress is worried that people aren't saving enough for retirement. And so they are going to start requiring people to be enrolled in their employer's 401k plans if the employer has one. And they said laying out the ground rules for us here as to how that works. Larger plans have been doing automatic enrollment for quite a while. Example is American National. We've had automatic enrollment in our plan for many years. And that's a not unusual feature to see in a larger company's plan. But now what they're doing is they're pushing this down to much smaller plans. Anybody with 10 or more employees are going to have to comply with this. And there's good reason for it. Studies have shown that plans that feature automatic enrollment have 90% or better participation rates as compared to 401k plans that have voluntary enrollment, where your participation rates are more around 40–50%. And so I think that 2 things are going on there. One is that people see that the reduction in their pay from being automatically enrolled in the plan is not that dramatic and it doesn't hurt them, so they just decide to let it roll. Or I think that there are some other people who just don't even notice it at all. And I also think that there are others that, yeah, they know what's going on, but they just aren't really motivated to change it. They just leave it alone and let it ride. So good and bad here. One of the things that we have noticed in smaller plans that do have automatic enrollment is that it puts a heck of a burden on the payroll people, because they need to remember to enroll people when it's time and to start taking those deferrals when it's time. And there are penalties for failing to take deferrals from people when you're supposed to. And so we've noticed that some small companies in particular, their payroll people really struggle with this. And that's why we're here. You know, we have our own in-house retirement services administration group that we can be there to help those small employers and remind them, hey, you know, it's enrollment time. Don't forget to automatic enroll your new people, as opposed to leaving these folks out there completely on their own. Another change that was actually in the original Secure Act, but has been modified under Secure 2.0, is this idea of long-term part-time employees participating in 401k plans. The original Secure Act said that long-term part-time employees must be allowed to make salary deferral contributions to their employer's 401k plan. Long-term part-time employees are defined as employees who worked at least 500 hours per year in the preceding 3 years. That means that you have to let them in to make contributions from their pay to the plan, but they do not have to be allowed into the plan for purposes of receiving employer matching contributions or employer profit sharing contributions. That long-term part-time employee provision under the original Secure Act is to be effective next year. Although we've been advising employers to keep track of your people that work at least 500 hours a year, because they're probably going to be joining your plan next year. What Secure 2.0 did was it reduced that 3-year period to 2 years. And so starting in 2025, anybody who's worked at least 500 hours a year in the preceding 2 years is going to have to be allowed to be in the plan to make salary deferral contributions. Now, again, that group is not necessarily eligible to receive matching contributions or profit sharing unless the employer elects to let them have it. But at the very least, they need to be allowed in to make salary deferral contributions. And of course, I think that this is a reaction to the so-called gig economy. People driving for Uber and DoorDash and whatever else you can think of, who people aren't necessarily working a regular full-time job at an employer, and a perceived gap then in retirement savings opportunities for those people that now they're looking to try to close by allowing the long-term part-time people now in to at least make salary deferrals. Number 4, new catch-up contribution limit. Beginning after 12/31/2024, the catch-up limit is going to be increased to the greater of $10,000 or 150% of the regular catch-up limit, but only for people between the ages of 60 and 63. And so why exactly they limited it to those ages, your guess is as good as mine. People right now, if you're over age 50, you're allowed to make catch-up contributions for 2023 of $7,500 in addition to the regular salary deferral limit of $22,500. And so they're going to increase that $7,500 to $10,000 beginning in 2025, but only if you happen to be between the ages of 60 and 63. So if you're 59, let's assume that the $7,500 limit doesn't change, which it probably will. That if I'm 59, I'm allowed to do $7,500 in deferrals. As soon as I turn 60, I can start doing $10,000 in catch up. But then once I turn 64, I'm back down to the regular limit of $7,500. No idea why they picked those particular ages, but there it is. Again, I think that it's a matter of concern about people accumulating sufficient assets for retirement. And so they're giving them the ability to defer a little bit more than they would under the current catch-up limits. But as we all know, the government just isn't going to give away all these tax goodies. They're also going to want to collect some tax to pay for these things. Pardon me. And so we're starting now to get into the provisions in Secure that I call the Rothification provisions. And if you're not familiar with Roth, what Roth is all about is that there's people can do Roth IRAs, people can do Roth 401k. And in particular with Roth 401k, the way that it works is that unlike the traditional 401k type contribution, where the contribution comes out of your paycheck on a pre-tax basis, so that it reduces the amount of federal withholding that you have on your paycheck. If a person makes a Roth salary deferral election, their salary deferral contribution is taken from their pay after taxes have been withheld. And the idea is then that those after-tax Roth contributions go into your account in the 401k plan, and they grow tax-free, and provided that you leave them in the plan for the required holding period, which for most people is until they're 59 and a half years old, you can then take your contributions plus the investment earnings that they've generated out of the plan tax-free. And so what the Secure Act 2.0 did was said that if you're going to make catch-up contributions, and if you have earnings in excess of $145,000, starting in 2024, you may only make your catch-up contribution on a Roth basis. So this is a revenue raising. The idea being that rather than let people who make more than $145,000 do their catch-up contributions on a regular pre-tax salary deferral basis, they're now going to require anybody who makes more than $145,000 to make that catch-up contribution on an after-tax Roth basis. Interesting idea. I don't know how much money it's actually going to raise, but and there have been some questions about this. And so this is where we need some guidance from the IRS, is that not every plan lets their employees make salary deferrals on a Roth basis. And so what do you do if you've got somebody who makes more than $145,000 next year, he wants to make a catch-up contribution? Are we going to be forced to add a Roth provision to our plan? Or do we say, too bad, you're in a plan that doesn't have Roth, so you can't do any catch-up? We don't know the answer to that. And so that's the kind of thing that we are looking for guidance from the IRS on. Now, this one's really interesting in that one of the things that the Secure Act 2.0 does is it allows participants to direct that employer matching and profit sharing contributions be made to their accounts on a Roth after-tax basis. This is very different from the way that employer matching and profit sharing contributions have been treated since the beginning in terms of their tax treatment. They have always gone into a plan as a deferred compensation for the participant. They don't pay any tax on those contributions until they come out of the plan. And they are, of course, deductible by the employer. And so what the participant's effectively doing here is saying, I'll pick on matching contributions. I want my match to be taxable to me now. And I want this to go into a Roth matching account under the plan. And as long as I hold it until for the requisite holding period, my match is now going to be tax-free. Or same thing with my employer profit sharing. I could designate that I want that to go into the plan on a Roth after-tax basis, and then as long as I hold it for the requisite period, that will come out to be tax-free as well. A lot of questions around this. and it was effective immediately when the bill was signed. But I know of very few plans that are actually doing this right now, and there's a number of reasons why. One is that record-keeping systems like ours need to be programmed to handle this, and we're not there yet. But how do you handle the tax reporting of the Roth election on the match or on the profit sharing? Does it flow through on his W-2, or does he get a 1099 for that? Nobody really knows. And so again, this is a very interesting plan provision that I could see in particular for well-off younger plan participants would want to take advantage of, in that they would like to see their bulk of their retirement income tax-free, but the details need to be worked out as to exactly how this will be handled on the more ancillary issues like taxation and reporting of that taxation. Number 7, this is something that I think was long overdue, and they delayed its effectiveness for 1 more year. Again, I'm not sure why, other than I think it was confusing to people, is that the minimum required distribution rules between IRAs, Roth IRAs, and Roth 401k accounts were different. That you did not have to take required minimum distributions from your Roth IRAs, but you did from your Roth 401k. So beginning in 2024, the treatment of Roth accounts in a 401k plan would be brought in line with the treatment of Roth accounts in an IRA, which means that those accounts will be exempt from having to receive minimum required distributions. Now, you couple that with what's going on with the ability to maybe elect Roth matching or Roth profit sharing for a young person just getting started. They may never have to take minimum required distributions at all down, many years down the road. Very interesting proposition. This one, oh, and I should mention something. When I was talking about catch-up contributions and the change in the limit and the Rothification of catch-up, one of the things that Congress inadvertently did was when they rewrote that provision in writing Secure Act 2.0, they accidentally took out the provision of the code that allows catch-up contributions at all. And so right now, as we sit, technically, nobody's allowed to make catch-up contributions to a 401k plan. It is assumed that somewhere along the line, a technical correction will get passed, or the IRS will issue some kind of a ruling or notice. But technically, anyhow, if you're making catch-up contributions, right, you're not allowed to. But I think they'll get that fixed. Number 8, increase in the required minimum distribution beginning date. And this has also caused some confusion, and there's going to be a great deal of discussion about this. My colleague Bob Scheft is doing a webinar. It's either later this month or it's next month about this as it applies to IRAs. But what they are doing is they are increasing the age to start receiving required minimum distributions from its current age 72 to 73 for participants who turn 72 after December 31st, 2022, and age 73 before age January 1, 2023. And then it is going to go up to age 75 for participants who turn 74 after December 31st, 2032. One of the things that has been pointed out here is it didn't apply to people who were born in 1959. And nobody's quite sure where people born in 1959 land. And so those folks are kind of in limbo until the IRS gets around to explaining exactly how this is supposed to work. It is effective for distributions made after December 31st, 2022, for people who would be 72 after that date. So it basically pushes out the required beginning date by a year for people. Now I'll mention in here just in passing that there is also a rule in retirement plans for people who are less than 5% owners of a business. They don't have to start taking minimum distributions from their retirement account until they actually retire. And so if I'm 75 and still working, I don't have to take minimum distributions until I actually retire. There's quite a few people like that out there who are still actively employed and are not required to take those distributions. That is not the case for their colleagues who are more than 5% owners of the business. If those people are still working, it doesn't matter. If they're 5% or more owners, they have to start receiving minimum distributions. A welcome change, I think, and item number 9 is a reduced penalty for missing required minimum distributions. You might remember that the excise tax on missed required distributions is 50%, which I think is very punitive. Why pick on Granny just because she forgot that she needed to take a minimum distribution? And I think Congress felt the same way and said, yeah, we're going to reduce that penalty from 50% to 25%, and we'll knock it down even further to 10% for taxpayers who either get their minimum distribution out of the way before an IRS audit, or if earlier, the second year after the year in which the excise tax was imposed. So they're going to give people a break and say, look, just get that distribution taken care of, and as long as you do it on a timely basis and the IRS doesn't make you do it, we're going to reduce that penalty to 10%, which I think is a lot more reasonable. This is very welcome news, I think, for pension case designers all around the land. I rejoiced when I saw this. One of the peculiar things about simple IRAs is that you're not allowed to have any other kind of qualified plan in the same year that you have a simple IRA. And I have had to turn away agent after agent after agent who has come to me with a prospect who either wants to change to a 401k or wants to add a plan like a defined benefit pension plan on top of their simple IRA. I tell them, I'm sorry, you can't do it right now. You've got that simple IRA, and the simple IRAs carry with them the prohibition against establishing any other kind of plan. And so we have to wait until next year. And oh, by the way, they got to terminate that simple before next year so that we can do something for them next year. But for years beginning after 2023, we will have an alternative available for simple IRA sponsors who want to switch. They can switch to a safe harbor 401k plan in the middle of the year, which in many ways looks and acts a lot like a simple IRA, with the key differences being, though, that you have significantly higher contribution limits. You can do things like take loans from a 401k that you can't from a simple. And so I'm glad to have something that I can offer now, a simple IRA sponsor, where I used to just have to turn them away and say, we'll see you next year. So that's good news. They saw the light and said, yeah, let's give these people an opportunity to put something better in for their people. The plus one that I also wanted to add to my top 10, and this one's really interesting. For many, many, many years, the deadline for an employer to adopt a plan and be able to count contributions made for that year and take tax deductions was December 31st. And so we were always incredibly busy in the pension sales group in the months of November and December, working with employers who were racing to get plans in time for them to take a tax deduction for the current year. Now, what the original Secure Act did was it said, okay, look, we're going to give people more time to adopt a plan. And so if you adopt your plan, and that means formally sign the plan document, creating the plan by the due date of your tax return. So for a lot of people, that's today. You are going to be able to take tax deductions for contributions made to the plan for the previous year, which is great, except it doesn't apply to 401k plans. If you're going to do salary deferral contributions to a 401k, you've got to have the plan in place by December 31. But if you're going to do profit sharing, or if you're doing a defined benefit pension plan, you have until tax return deadline time to sign off on your plan document and be able to take that deduction for contributions that you've made. What Secure Act 2.0 did was it took that concept a little bit further and extended it to salary deferral contributions in a 401k plan, but only for sole proprietorships in single member limited liability companies. And so those folks now have until due date of tax return to not only create a plan that they could say take a deduction for a profit sharing contribution, but also to make employee salary deferral contributions. So, the 2022 limits were $27,000. So if they could get another $27,000 in salary deferrals. As a practical matter, and this was effective on the date of enactment of the statute, which was December the 29th, which is a practical matter meant, though, that you're only going to have 2 days worth of deferral opportunity for these people. But beginning this year and next year and after that, if you have a sole proprietor or a single member LLC that wants to set up a 401k plan, say for 2023, and they come to you in February of 24 and say, gosh, did I miss the boat? The answer is no, you didn't. We still have an opportunity to do that for you. What's curious about this is that they didn't extend this to partnerships, which in many ways their tax issues and taxation is the same as for sole proprietors. But they limited the application of this to just sole proprietors and single member LLCs. So partnerships out of luck if they show up in February, for example, talking to you about trying to do a 401k. That might be something that will be a technical correction down the road. I don't know. But for right now, keep that in the back of your mind that late next year or early next year, someone comes along and says, gosh, I really wanted to do a 401k plan last year, but I didn't get it done in time. You can say, not so fast. We still have an opportunity. So that's my Secure Act 2.0 top 10 plus 1. If you would like to get in touch with us in the pension sales group, you can email us at pensionproposals@americannational.com. You can give us a call at 888-909-6504. Choose option 1. That's the easiest way to get to us. And I encourage everyone viewing this webinar to pay a visit to our pension sales website at pension.anicaweb.com. There is a ton of very useful information out there for agents, marketing pieces. There's information about the different products that we offer for retirement plans. There's places there where you can download a plan design questionnaire if you want us to create a proposal for a prospect that you have. Just all kinds of really good information. You don't need a password or any username or anything like that. You just come right on in and take a look around. With that, I end the formal part of my presentation. If anybody has any questions, I'd be glad to try to answer them for you.
Hey, thanks, Bob. I appreciate the presentation, very detailed, and I hope everybody got quite a bit out of that on understanding the new Secure Act 2.0. Just as a reminder to everybody, if you have a question, please just type that into the question box on the right-hand side. I'll be able to see that come through. And while you're typing those questions in, maybe Bob, can you maybe just explain in your 30-second to 60-second overview kind of how that product works and why people don't need securities license outside of Connecticut or Massachusetts to be able to work with this product?
Sure. Very briefly, what our non-registered group variable annuity contract is a platform that has resting on it 50 plus different investment options that, in particular, 401k plan participants may choose from. So they range from fairly conservative options such as money market funds and government bond funds to fairly aggressive options such as international equity and small cap growth. And the idea then is that each plan participant will decide for him or herself which of those options they wish to put their contributions in. The reason why an agent without a securities license can sell this product is because of a provision in the Exchange Act that exempts from registration insurance products that are sold in connection with qualified retirement funds. And that's exactly what this product is for. It's exclusively for use by retirement plans. And because of that, then, since it's not required to be registered, most states take the position that, well, it's not required to be registered as a security, we're not going to treat it as a security for purposes of licensing to sell. As I mentioned, 2 states, Connecticut and Massachusetts, take a different position that they say that given the nature of the product, regardless of whether it needs to be registered or not, we are going to require people to have licensure to sell it. And I should also mention that it is not available for sale at this time in New York. But if you're in Florida or Texas or California or Wyoming or anywhere else, Hawaii, this product is available for sale and you needn't have a securities license in order to sell.
Excellent. Appreciate that, Bob. And right now we don't have any questions. I will let everybody know, I should have mentioned this at the beginning of the call, but on the right-hand side of your screen in your menu bar, there should be a tab that says Handouts. And I did attach a brief document that goes over those new plan tax credits that you can pull up right now and download so you have that. And also I mentioned we'll send out this recording to all of you so you have it to reference back. And along with that, I'll pull some materials on that pension product to send out with that. And in addition to the contact information that you see on your screen, you can contact us directly here at Financial Brokerage, and we can be your initial point of contact for facilitating some of those sales that you might be thinking of. So with that, I will go ahead and wrap up. And thank you again, Bob, for that very detailed overview of the SCOOR Act. Thanks to American National as a whole for being great partners, and look forward to working with all of you on some of these sales. Thanks, everyone.
My pleasure. Thank you.
Thank you, Bob.
All right. Bye now.